for any asset you own, think of the dilution. So if you're owning fiat currency and the currency supply is growing by 7% per year, you're owning a smaller and smaller share of that network. Equities and real estate have different dilution rates. So for example, real estate might have a 1 or 2% long-term dilution rate. Gold has something like a 1.5% long-term dilution rate due to new mining. So for any asset that you consider owning, a first step is to know the dilution rate, both in terms of the number of units, if you can, and also market share. Is it kind of being diluted because it's losing market share in a big thing? So I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others. And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but zero is probably not the right one.
Lyn makes a compelling point. Whatever your level of conviction, the right allocation to Bitcoin is probably not zero. Some people are more than 100% all in, often using leverage. Others might only allocate 3 to 5%. But the worst position is having none at all, because that means missing out entirely on both the educational process of using it and the asymmetric upside it offers. Her advice? Own at least a little, send a transaction, get familiar with the system, and keep some skin in the game.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Why do they have 40 billion or 50 billion in debt? And it's because they can. Basically that, if someone's going to offer them the ability to, issue bonds for 10 years, 20 years, 30 years at 2, 3, 4%, which, until kind of recent high rates they were able to do, it's lower than their other cost of capital. They say, well, if we're going to borrow at 2% and buy back our own shares with it, they're arbitraging the fiat currency system just like everyone else. They're just doing it in a less volatile and explosive way as doing it with Bitcoin. And so that's been kind of the go-to choice for a lot of companies, whereas Bitcoin is one, until recently it wasn't really big and liquid enough to be on their radar. Then the accounting issues were there. And once those things were addressed, like now that it's a $2 trillion network, now that the accounting issues are addressed, we do see it popping up more. But I still think it'll take years because of the high volatility aspect of it, which means that it's more disposed that someone who owns a lot of the company. For example, Michael Saylor had dominant voting rights in the company. So if you're able to convince one person to make a really decisive move, that's where that tends to show up. It's also, I think, not an accident that Fidelity was earlier into Bitcoin than most other financial institutions, because that's a more privately held entity. So if the CEO was on board with it, it could happen. Whereas if you have a more diffused ownership where the CEO might only own 2% of the company and is basically just an employee there rather than like a true owner, you're less likely to get that kind of high conviction decision making compared to entities that have tighter ownership. That's also why you see a lot of small businesses, small private businesses will own Bitcoin. And you'll see a lot of people that are, they might be on the board of a pension, they might be on the board of a bank, and in their personal life, they might have a lot of Bitcoin because they can just make that decisive decision. But there's no one really in place at a lot of these types of entities that can just make a pretty decisive call like that if there's any degree of controversy to it, which there is because of the volatility and historically because of the accounting treatment. For any asset you own, think of the dilution. So if you're owning fiat currency, and the currency supply is growing by 7% per year, you're owning a smaller and smaller share of that network. Equities and real estate have different dilution rates. So for example, real estate might have a 1 or 2% long-term dilution rate. Gold has something like a 1.5% long-term dilution rate due to new mining. So for any asset that you consider owning, a first step is to know the dilution rate, both in terms of the number of units, if you can, and also market share. Is it kind of being diluted because it's losing market share in a big thing? So I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others. And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but zero is probably not the right one, which is to say, there are people that are more than 100% all in, like they're levered long. And there are other people that a 3 or 5% allocation could make sense. But I think that if you don't own any, and if you've never sent a Bitcoin transaction, I do think that going forward, that's a good thing to have done. It's a good thing to have, at the very least, you've educated yourself on the functionality of this, but it's a different way of doing money. And I do think that going forward, just zero is not the right number. It could be an amount that's not that important to you, but at least you have skin in the game now and maybe would pay attention to it going forward. Over the next 5-10 years, I do expect volatility will decrease. And I view it as a good thing because as it kind of gets higher toward its total addressable market, we'd expect volatility to decrease. And also part of why people don't use it for payments at scale is that volatility. So you can't really price things in it because of that high volatility. We still live in a very fiat world. Our liabilities, either in debts or in just ongoing obligations, rent, mortgages, things like that, our expenses are in fiat currencies around the world. So people can't really price things in Bitcoin. If Bitcoin does get much larger and more liquid and the volatility goes down, that actually opens the possibility where people could price things more readily directly in Bitcoin, especially when you're talking about a context where, a continent with 40 currencies, and it can become more of a standard that people use. So I do expect volatility to decrease, and while the downside is it takes away from the explosive return potential over time, I think the upsides outweigh it. But I also think we have much more to go, most likely, before that volatility gets, to what we consider low, like gold.
Many skeptics argue that a new cryptocurrency could someday displace Bitcoin. Lyn challenges this idea with a comparison to communication protocols like TCP/IP, SMTP, or USB. These technologies became dominant standards, and once established, they weren't replaced by competitors. They simply evolved and improved incrementally over time. Bitcoin, Lyn argues, has achieved a similar network effect dominance in value transfer.
Starts in 2009. It's tiny. It's up against the $100 trillion fiat currency system, and so it's slowly growing into that. Right now, even at a $2+ trillion market cap, it seems big, but it's something like 0.2% of global assets. Gold at something like a 20 trillion network size estimated is around 2% of global assets. So I think Bitcoin is going to grow into kind of the role that gold fills to some extent, but then potentially has a avenue to grow further still because it's able to solve things that even gold itself as a money can't solve. So there's certain things obviously gold can do that Bitcoin can't do. You can use it in industry. It has all these kind of practical purposes, but as a money, Bitcoin is in many ways more powerful. It's able to beam around the world in 10 minutes, even faster by using some higher layers. Our first thought is, well, the first technology is going to be the one that gets displaced. It's going to be some later thing that comes and displaces it. And the way that I've kind of conceptualized this is that the really big exception for that is communication protocols. Those so far tend to have a very long life cycle of lasting. So whether it's Ethernet, whether it's simple mail transfer protocol, whether it's TCP/IP, whether it's USB, once these things kind of become dominant in their fields, they tend to they update over time. So what displaces USB is the next USB rather than literally a competitor. And two, the complexity and the fast moving parts, that tends to happen at the periphery or on higher layers, whereas the core of the system itself is kind of very simple. And I think that Bitcoin is kind of following a similar approach, which is this new communication protocol that exists. And in this case, it's a communication of value, and it's achieved basically network effect dominance. So it becomes increasingly less likely that something within its own field will displace it in a similar way that Ethernet and USB and others have kind of achieved dominance. And therefore, it's going to grow into whatever total addressable market it has. which I think is north of gold's current 2% of global assets. I think that basically people solve the problem they have. And for most parts of the world, people, when they wake up, they don't have a payments problem, they have a store of value problem. That's something that people in developing countries have. And then even in developed countries, we just have a slower version of it, is where are we going to store our value? So that's something that basically 8 billion people in the world have as a problem. Payment problems, while some people have them, they're way less universal. Most people in developed countries don't think I have all these payment frictions all the time. Now, certain areas do. There has been, for example, debanking. In certain countries, people have the issue. Like I point out that there's over 40 currencies in Africa. There's over 30 currencies in Latin America. So we can imagine in the United States, if every state had a currency, and imagine all the cross-border frictions, not just in terms of payments, but in terms of cross-state lending and things like that. So if an entity in New York wants to lend to an entity in Michigan, and you're balancing 50 different currencies, and so a lot of the world actually kind of lives under that type of friction-filled system. So they, especially in a cross-border sense, you're more likely to have payment frictions. So I think that the problem that Bitcoin is kind of filling into, the thing that it's solving, is more that portable store value problem. So it's portable capital. But then around the margins, it can also solve payment problems for those that have it. But then in addition, that's a crowded field. So for example, stablecoins, not for every person, but for a lot of people, stablecoins solve a lot of their frictions as well. So going back to that example about Africa, like you'll see a lot of stablecoin volumes happening in several countries there, like Nigeria, because especially for shorter term holding and paying, stablecoins are equal or in some cases better than Bitcoin at that specific task. And where Bitcoin really shines is that over that long arc of time, it can't really be sanctioned. It's not centralized. It doesn't debase. It's truly permissionless rather than this kind of centralized node on top of a blockchain. And so I think over time it grows into more of that payments aspect. But I think in the current time where it's high volatility and it's growing into its total addressable market, it more serves as that kind of portable capital aspect.
This is why Bitcoin's role as portable capital is so important. It allows individuals across the globe to store and move wealth without permission, censorship, or debasement. That said, Bitcoin can also address payments in regions where frictions are extreme, such as Africa and Latin America, where dozens of currencies create barriers to trade and lending. However, in the near term, stablecoins may be better for payments because they are less volatile and pegged to familiar units like the US dollar. Over the long arc of time, though, Bitcoin's decentralized, non-diluting nature gives it the edge as the ultimate monetary settlement layer.